have Mr. Aman Siddiqui on via Skype, and we're gonna talk a little bit about the markets and sort of try to pick his brain. I met Aman when I was doing interviews at CNBC London, and there's what we call the green room, and in the green room you have all the different guests, and that always gives the opportunity to actually, talk with like-minded traders and strategists. And I always found Aman's point of view on the market interesting, very different to mine. And so I thought it would be awesome to have him on here and sort of get a bit of a different perspective on the markets than you would usually get just by listening to me. So Aman, how you doing, sir?
I'm good, sir. Thanks very much. Very flattering.
Yeah,
A bit
no,
embarrassed.
yeah. So tell us a little bit about yourself. What's your background? What have you been doing so far?
So I started off in the market, I think, back in 93 on 1995 after university. I have a degree in physics and computer science in the applied sciences, a double major. I came to university, started working for Lehman's when it was actually still solvent and actually bankrupt. So I started my career at Credit Suisse, Lehman's, Goldman Sachs, working on the trading floor, designing trading floors, networks, and actually we're doing the very first algos back about 25 years ago using Excel spreadsheets. I moved up from that into more of a sort of a brokerage facility, trading for hedge funds, institutions, private clients. And now actually we're starting our own hedge fund in about 3-4 months time. So it's raising the finances and going through all the compliance regulations to actually do our own fund going forward this year.
All right, all right. So what kind of hedge fund is it that you're gonna be working for or
Well,
setting up?
we're now moving towards an algo-driven momentum hedge fund, effectively. So it's a trend follower. It just looks at data coming in effectively. The problem is now there are so many ways of actually applying these algo hedge funds. It's limited. You can have a news hedge fund. You can have a Twitter hedge fund. You can have ones trading on volatility. But we're using a more holistic approach, using technicals, fundamentals, using RSIs, momentums, risk parity issues, volatility. Really put that into an equation. And so we give a plus minus figure on the trade, giving some idea actually where the market's going to be, not just minutes, but really the next couple of hours, maybe over the next 3-4 days. So it's not really minute by minute algo. It's more of a sort of daily, weekly algo.
Okay, that's interesting. So
Yeah.
what's your view on these algos in general, though? I mean, will they replace us strategists, or or do you think you still need
I say,
strategists like ourselves to actually figure out what to put into it?
hand on my heart, I don't like algos. I think they kill the market. The problem is, this is the way everyone is now going, not just the hedge funds, but also the institutions, the sovereign wealth funds, the banks, in fact, even governments, they're all going the same way. And actually now, if you look at the market, 20, 30 years ago, the breakdown in the market was probably 50, 60% retail with 40% institutional. What you're seeing now, the retail sector has come right down to about 10%. We've had 3 drawdowns in the last, I think, 3 decades, which destroy retail investors. So all you're left with now really are the hedge funds, institutions trading against each other. And that's why you're getting these such strange maneuvers now in the market. So really, I think what we're doing now, we're going with the flow until the flow lasts. Because at some point, maybe in 5, 10 years, you will have regulations on algos. And there'll be limitation, just like there was limitation on CFDs last year.
Yeah, that's interesting actually. Which actually brings me to another topic, which could probably talk about some other point, but obviously with automation, what's going to happen with normal people when they don't have any more jobs?
Yeah,
Maybe they're going to introduce taxes on
yeah.
robots and to help to pay for welfare and things like that. And obviously not necessarily related to exactly what
Yeah.
you said, but it's some sort of a form of regulation. And obviously what's with those two concepts, it's all about automation actually, sort of
What will
replacing
be
humans.
You're absolutely correct. And there will be taxation on robots within 2, 3 years. That's no doubt. That's actually already in the pipeline.
Yeah,
If you're replacing workers, you have to have some money raised in taxation from the machine to actually provide health benefits for human workers. That's
yeah,
actually coming into play now.
yeah. Awesome. So let's talk a bit about the markets. The Fed rate meeting yesterday,
Yeah.
I read the statement and I was like, wow, okay, this is not really that bullish. It's not really hawkish or not dovish. Of course, they highlighted a bit about inflation not being too strong. But then, of course, the statement afterwards by Jerome Powell, where this sort of tells us that they're not looking to make any major changes in either way now, obviously surprised the markets a bit. What do you think about this? Do you think the Fed is right, or do you think they're wrong? Will they be forced to cut, or what do you think is going to happen?
So look, as you know my view. So for many years now on CNBC and the stuff I do in conferences, I've made it very clear now that the Federal Reserve is in a panic mode. They have lost their direction. Go back 20, 30 years, the Federal Reserve had two mandates, price stability and jobs. Now they have three mandates, price stability, jobs, and stock markets. And it's not a written mandate within the Constitution, it is an unsaid mandate which is confirmed by any number of Fed governors. You talk to Dudley or these guys, they'll confirm, yeah, it's actually, we're looking at stock prices as a factor of stability. So now stock prices are in their sphere of influence. That's what we're seeing now, really. The Federal Reserve really trapped in their own mindless rhetoric about wealth effect, about QE, about low inflation. Let me make one thing very, very clear. If you live in the US, if you live in Dallas, Houston, North Carolina, if you go to a Walmart to buy one tomato, that one tomato would cost about maybe 10, 15 cents 10 years ago. That tomato is now 30, 35 cents per tomato. That's inflation. Okay, you have inflation. The problem is that in the basket of central banks, they don't include tomatoes or bread or milk. They include iPhones, USB adapters, TVs, the stupid things that really are affected by import-export prices. So real inflation, what we call real inflation, real GDP, real inflation is probably running at 2.5% to 3% in real terms. The inflation, the measure that they use is actually much, much more. And there's a reason for that. The Federal Reserve don't want you to know that actually real inflation is running at 3 to 3.5% over time, because they would have to raise rates. If they raise rates too fast, they destroy the moral hazard that they created. I'm talking the asset bubble. I'm talking stock prices being at all-time high. I'm talking housing prices at all-time high. I'm talking art prices at all-time. Because the fact is that the Federal Reserve, by doing QE, has created an environment where the investors have to go into 3 or 4 select areas, pushing all the prices up, creating a false impression that actually we're doing fine when we're not. So I think the Fed is between a rock and a hard place. They're in a trap. At some point they have to raise rates. If they don't raise rates in the next couple of years, you're going to have a real blowout on the housing price, as we saw in 2008, where valuations halved. The next blowout on housing and mortgage properties will be even worse than 2008, 2009.
Yeah, I know what you mean, and it's actually quite interesting because, like, the different statistical bureaus across the world, when they update their consumer price index, the basket, what they actually say is like, hang on, yeah, we TV prices are up in price. However, it's not the same TV anymore. This is a smart TV now, so it's a different product, obviously an innovation. So they try to compensate for that, and that could understate the inflation.
Oh, exactly.
Uh, in general, it's actually quite interesting, though, is that the Fed has a mandate of 2%. And I think at one point, academics sort of figured out that, well, if you have inflation at 2%, you're going to have some decent economic growth. But I'm actually not so sure that that's always the case, that you have to have that 2% inflation target there. And then again, as well, what you say a bit about that they're pumping all this money to keep the economy strong, or apparently strong, but obviously the man on the street notices that things so far a bit more expensive, and will we have a big crash like you just say? Maybe there's definitely going to be some issues at one point. um, I'm not sure exactly though it's going to be as bad as you think.
I will I will pinpoint the reasons why we're about to enter a huge recession and a huge crash. Okay, you can engineer financial markets whichever way you want. You can have EPS going high because you're buying shares and reducing the float in the marketplace. That's easy. Everyone does that. Apple, IBM, they all cheat by actually increasing EPS by reducing the share float. You can do that. That's no problem. You can have dividends. That's no problem at all. Right? You can have QE. You can buy all the bonds you want, all the corporate bonds, or the treasuries, or the sovereign bonds, meaning that people like me and you, or bank investors, what do we buy now? We have to buy corporate bonds. We have to buy equities. So we're forced into that area, and that creates a false impression.
Yeah.
In the final analysis, whatever, right? Housing prices have gone up. Why? Why did housing prices rise? Because they cut rates to zero. And what that meant was that investors could go out, rich investors could borrow at zero rates and buy property all across the board, no problem at all. But what it meant was that people at the bottom end of the ladder, the working class, the middle class, had zero income because effectively they're relying on their savings. But if you're zero rate on interest rates, if it's NERP as we call it, negative interest rate policy, if you're zero on your savings, you're not making any money. Therefore, you cannot spend any money. So the rich benefit from this QE, and that's where we get this word of this wealth inequality. That's what wealth inequality really means. It's a transfer of wealth from governments into the hands of the very rich in the belief that they're going to buy 2 Starbucks coffees and buy a cheese sandwich, and that'll filter down the economy. That does not work. That's never worked, never will work. The rich, all they do is they buy more Ferraris, they buy more mansions in south of France. That never gets down to the working man. That's what creates the wealth inequality. But let's get back to the main issue. What's going to cause the recession? Well, I'll tell you one thing. Look at the US, okay? So one of the main metrics that the Fed follows and what the banks often follow is auto loans. Okay. Now we've had in the last 10 years since 2009 a huge expansion in auto loans because rates were zero. Right? As rates have risen over the year, what we've seen in the last couple of years is that the 90-day delinquency in auto loans has risen by 15-20% last year alone. What that means is that those people who are 3 months late on payments on their car loans is already increasing by 15% on the month, whatever. What we're also seeing is delinquencies on mortgages, the 3-month also rising.
So what levels are we at right now for both auto loans?
I
like
know that on the auto loans, delinquencies are, I can't give you the exact figure, but I looked at my research last night and there was an increase on delinquencies on both auto loans and mortgage. And not only that, there's also now, if you look at credit cards, so one other key metric, when you're evaluating banks, the one metric you look at is credit, and when they're taking in from consumers on consumer credit. What we've seen is that the delinquencies on credit cards and loans has also risen as well over that 3-month period. We're getting more delinquencies both on credit card, on home loans, on unsecured loans, on auto loans, on housing loans. Now, the one place that we saw all this occur before was in 2006, 2007, before the Great Recession. That's the last time we saw a confluence of such events actually occurring at the same time. That's the last time. Let's move on. Let's move on to actual stocks. Look at Apple. Apple did great. It's up in the day. It beat the earnings, beat the estimates. But actually, hold on. Let's go back to Apple earnings. If you look at the earnings themselves, they're actually lower than last year. And the guidance is actually lower than what they had originally 3 months ago when they cut guidance. So actually, Apple has done nothing. They haven't beaten the year-on-year. They haven't beaten the year-on-year revenue. They haven't actually increased their guidance 3 months ago. And actually, if you look at iPhone sales year-on-year, they're actually down 17%. So the main product Apple actually makes is iPhone sales to the world. That's actually decreasing in sales and revenue value. And same thing for Samsung, same thing with other. The only firm actually increasing revenue on the smartphone is Huawei in China. So what we see now really, we see discretionary spending being reduced, and we're seeing things like loan spending also coming into focus. So these are a couple of things which give indication which way the market is going. So that's what we keep saying, and I keep saying to TV that we are due for a recession very soon, based just on these factors alone.
That's interesting, actually. I'm just showing the guys an article right now that I found on Bloomberg. I just did a simple search here. It's from February 12th, 2019, and apparently auto loan delinquencies are at the highest since 2012,
Exactly.
and the number of loans that are at least 90 days late exceed apparently up to 7 million,
That's
7 million loans.
a huge
That are,
increase.
yeah. And as a percentage, expressed as a percentage of total debt, the delinquency rate is at the highest since 2012.
Right, that's my whole thesis. We always work on a 3-month due basis, and you can see they're clearly, Bloomberg are saying it too. We're in trouble in terms of the loan market, effectively.
Yeah, that's interesting. That's it's obvious. It's definitely interesting to keep track of this. So if we do have a recession, when do you think that's gonna kick in?
Well, so our thesis was ready for recession either middle of this year, beginning of second half, or the end of this year, effectively. And we were looking at to be tied into a rate cut occurring probably in the third quarter. We have no doubt now the Federal Reserve are going to go for a rate cut. John Pallasner came on, he's very non-committal. he didn't talk about a rate hike or a rate cut because he's actually now in trouble. He knows himself now that really, if you start raising rates, you're going to destroy auto loans, you're going to destroy the housing market. But if he doesn't do it, you're creating the asset bubbles. You have the moral hazard. So the
Yeah.
problem is, how do you deal with the moral hazard? And that's what, when we just talk about markets, about financial markets, we talk about moral hazard. That's the moral hazard. You're giving one person who is a billionaire more money to buy more things, whereas the guy at the bottom of the rung, works in Starbucks, has got nothing. And that's the moral hazard that we all try to avoid. Unfortunately, with QE, you can't avoid that.
Yeah. Which sort of markets would you be working with? Would you just short the S&P, or how would you position yourself for a potential recession?
So basically, look, our long-term thesis now really is that we believe that Western Europe and the US is now actually in saturation. They peaked. They peaked about a year ago, maybe 2 years ago. We've seen the last end of the bull cycle. They're done effectively. You see now things like manufacturing, PMIs, ISM services, they're all falling now within Western European and US markets. That's done. What we are looking at on a long-term basis over 5, 10, 15 years is the emerging markets. And we said for one good reason. Okay? On a long-term basis, we think now that the separation or divergence from emerging markets and the West, as in fact that EM makes things that Western Europe buy. So they make TVs, they make fridges that we in the West will buy. That's now decreasing. What you're now seeing is that those products made in EM are being consumed in EM. So that's showing the change in the economy. It's going from an agrarian, export-based economy to being one of a domestic, consumer-focused-based economy in the EM markets, and that's the real going to be the real force of the next 5, 10 years. Also, in terms of demographics, what you see now in the US and Western Europe, you're seeing a falling demographic. You're seeing falling birth rates. That's a problem for really in Western countries because your pension liabilities will go through the roof. But what you're seeing in emerging markets, you're seeing demographics actually stay stable to go a little bit higher. So they're producing more taxpayers every year, whereas we in the West are decreasing our taxpayer base effectively. We're not producing enough consumers, enough taxpayers. So we think the emerging markets in just 5, 10 years on a macro view is going to be the place to be, and they will outperform all US and European markets. In the very, very short term, so we're talking maybe over the next 6 months to 5 months, we're looking to sell every rally. European markets, and particularly in the US, and the Dow Jones, S&P, perhaps the Russell 2000, I'm not sure about that, but definitely NASDAQ, definitely S&P and Dow, FTSE, DAX, not the Italian market, that's just too volatile. But remaining market, we're looking to sell every rally that we can effectively. We do not think that there is a thesis going on, but we're going to be higher now than we are based. All we've seen really is we were at 26,500 on the Dow before Christmas, had a huge drawdown, 20%, and now we're back to slightly higher from that point effectively.
But to trade that view, then you wouldn't necessarily have an outright short position. You would hedge that by being long some emerging markets. Is that what you're saying?
No. So initially, it's probably quite safe to go naked short the next few weeks, next few months. But over the long-term period, if you're doing a pair trade, then yes, over the next couple of years, you want to really be long, really EM, and short, really Western European indices. I think in the short term, if you're just trying to bring money in quickly with tight stops, then selling European and US markets is probably fairly safe, actually, knowing the range that we've seen now in these markets.
So do you have is like some sort of levels, for example, in the DAX or maybe the S&P 500, where you would say, okay, I'm happy to sell, but I'm not going to keep this position forever, because obviously 70% of all years over the last 120 years, stock markets go higher, right? They end positively for the year. So the likelihood of having a bearish year is just 30%. Obviously, you're telling now that it's more likely that we're gonna see some sort of peaks, but there must be be some level where you think like, or at one point where you say your thesis is not right. So what are the factors you were looking at there?
For example, right? As an example, on a very broad-based example, if the Dow Jones breaches 27,000, then that negates our bearish scenario. If the DAX breaches 12,600, 12,800, that also breaches our negative scenario, because at that point, then we're just going to go forward with momentum as stops come in and play above that level.
Yeah.
But we believe fundamentally, is that this is probably peak of the market. What we see now really was a situation where you had funds piling in at the end of January, February, who sold, who bought higher and then sold lower were actually doing the same thing now. So they are actually buying at higher prices than actually bought originally. So they have got positions in play effectively. Then you have a situation where you have FOMO. The fear of missing out. The last month has been really the fear of missing out. As funds are compiling, market keeps on going up with no retractions. You know, every day we comments about the China trade deal, comments about the Federal Reserve, comments about infrastructure. So every day the market is pushed higher on headlines. Funds see that, clients see that, and actually pile into the market on every dip. On every dip, sorry. So what we're seeing now, effectively, really saying that's now actually done. If you look at volumes of the market, we now have decreasing volume in the market now. So if you look at as the bear metric, the move on S&P in the last 3 to 4 months, maybe 3 months, that's been predicated only on 25 stocks within the S&P have moved the market higher. That's an amazing figure. To go from 2,700, 2,600 to 2,900 on the S&P on only 25 stocks, that's a damning indictment of volume. So market breadth is not good. You look at New York Stock Exchange advanced decline lines, market breadth is not good. It's predicated on a few stocks. Same thing on NASDAQ. NASDAQ move is predicated only maybe on 4 stocks, on the FANG stocks. So we think really in terms of market breadth, in terms of volatility, in terms of the market volume, on those sectors, we think we're limited upside. Upside in these markets, US market maybe 1%, 2% as a maximum. The downside, we're looking at 5, 6, 10% drawdowns over the next 2 months.
Okay. So okay, that gives us a little bit to work with then. All right, that's good. I think you understand a bit better now about the situation and your view on the markets. So I have a little chart here showing an S&P 500 chart right now for you guys, and you can see how the price, at least technically, is trading sideways between 29.11 and 29.58.8, which is yesterday's high.
Yeah,
So
yeah,
so you're saying that we may potentially trade higher with maybe 2, 3 more percents, but in general,
no
you
more than that. Yeah,
no more
yeah,
than that. You will look to sell and then potentially see some 5 to 6% decline. Uh,
yes,
yeah, okay, I get it. So pretty much back to levels we saw early February, more or
yeah,
less. Yeah. Okay,
yeah.
that's really interesting. Okay, good. I think we got some good input here from you, Aman. I want to thank you so much for joining us. Let's check see here if we have any questions. It's the first time doing this, of course. So uh,
Oh,
yeah.
no.
Okay, actually, this is a bit interesting. It's industry related, but we have Marvin asking, "Hi, Aman. What is your view on the ESMA regulation changes regarding margin reduction for retail traders from last year? Do you think that was a good idea? Also, do you think other entities such as the Australian ASIC will follow suit?"
Well, hi, Marvin. My view is it was a total disaster. And my view is it was a political decision. There was no need to go 6%. They could have gone to 3%, 4% margin, and that would have been fine. But they went 6%. And that effectively killed the CFD and FX portion of the market. And there's a reason that this was actually done. This was done under pressure from the US regulators. I don't know if you're aware now, Alex, Marvin, is that next month, for May the 6th, my apologies, that CME is now introducing micro futures on the euro and on the Dow Jones. So $1 futures from the US from an exchange, which is regulated exchange. That was the whole point of enforcing ESMA regulations. First, we had complaints from people who couldn't trade the markets, who put in £3,000, lost the money, and then complained. That was an issue. The second issue was the pressure coming out of the US from the CME, from the SEC, basically, saying, get this product out. We don't want this product in the market. They removed that, and now we learned just last month that the CME will introduce in less than 1 week a product which is a $1 future, and the margin will be probably a bit less than CFD margins. So no, I wasn't happy about that, and I know what happened. So yeah, I mean, you could go offshore to a Maltese or to a Cypriot or to an Australian broker, but I suspect that within a year, 2 years, ESMA will relax their rules and reduce their margin from 6% back down to 3 or 4%.
Yeah, it's actually quite interesting that you say that because I know definitely because I was working for an American broker for from 2009 to 2006, and the
Yeah.
CEO over there, he had like huge problems with exchanges because exchanges, unfortunately, over there, they have such strong lobby groups,
They're very powerful.
and like in the America, you only have, I think, you have well, you only have 3 or 4 big brokers, or actually 3 brokers. I think that's pretty much it, and it's just because they want to have control. Now, I personally have a little bit of an issue with that because I don't like monopolies.
It's not
Uh,
a free market. Yes, exactly. Yeah.
it should be a free market, and I feel a bit sad sometimes for like my American followers and clients, because forex is not always the best thing to trade all the time.
No,
Uh,
it's not.
Now
It's
your
not.
dollar hasn't really done so much over the last year, so but you could have traded the S&P 500. That's some decent swings. Russell 2000. You could trade crude oil,
Yeah.
but if you want to trade crude oil over there, yeah, okay, you can buy an ETF,
Yeah.
but the liquidity is not the same. Uh, and it would have been better just to trade maybe a CFD that gives you some sort of liquidity, at least for the retail trader, which is very
Or,
similar to trading on the
or,
exchange.
exactly. Yeah. That's
Yeah.
right.
But I think the contract size on crude oil prices, I mean the margin requirement is at least maybe $2,500 or something.
Yes,
So,
it is.
and then again, that's outside of the scope really for retail traders. Again,
Yeah.
I understand as well from the regulators' point of view that some people get into this and they sort of think it's so
Without
easy to make money, not knowledge. I don't know, actually. Did you see that article on the Daily Mail? I don't read the Daily Mail. Uh, I just go there for the pictures.
yeah.
but no, but what is interesting is that they had an article about the 16-year-old kid that
Yeah.
put 150 pounds and
Right.
made 60,000 pounds.
That's right.
And now he's gonna buy himself a Mercedes for 30,000, and apparently he had about 100 people following him,
Yeah.
and they were paying him like 155 pounds per trade to get to know
Yeah.
him, to get to know his trades. And
Right.
obviously those sort of articles, unfortunately, just gets everybody hyped up. If a
Yeah.
16-year-old kid can make 60,000 with a 150 pound
Yeah.
deposit, then why can't anybody else do it? And unfortunately, I think it's a bit misleading, and I think it's these people then that go and complain.
It's misleading because what happens is that you were given a very powerful tool in safety. It's a very powerful tool.
Mm,
Problem, it was misused by not only the retail clients but by brokers and by the advisors. Okay. The problem with CFDs is that you can, I've worked at various retail firms at ODL, worked at many other firms and retail clients, and also I've been trading myself for many years. I can tell you now categorically that back in the old days, early 2000s, late 2000s, I could boredom, put in £2,000 and make 9,000 in a week over 2 weeks, just on my own account, not including client accounts, because it's so powerful. Because you're applying your technical expertise, you're applying stops, limits. You had all this in play. The problem is, it became so common practice. No one used stops. No one used any kind of protection. So that's what happened. The leverage factor, if you go the wrong way, it can actually blow up in your face if you do not use your correct stops, correct limits in the marketplace. But if you apply your trading rules as you would to any other asset, to CFDs on a normal trade, then it's a very powerful product. I mean, we used to, just for fun, put in 2,000, 3,000 and make 9,000 over a 2 week period for doing nothing, just trading Dow Jones and FTSE in and out basically all day long on stops or pre-programmed stops and limits. The problem is people don't obey the rules. They start getting very greedy. We start buying larger size, large exposure. From going from £2, £3 a point, they go to £100 a point. Once you're £100 a point, 100-point move, you're at a grand within 15 seconds. And that's what actually happens. It's the leverage that people don't understand.
yeah, I agree. Do you think now the Australian regulator is going to follow suit as well?
They're going to have to, because at some point they can't be an island unto themselves. They have to forward in global regulation. Unless, of course, you're trying to say, okay, you know what, we're not going to go with the regular, we're going to avoid ESMA, we're not going to go with the SEC or with the FCA or with BaFin in Germany. We're going to go our own way. I don't think that's going to actually happen much. I think they'll have to fall in line effectively. If they do fall in line, they expect those margins will also rise too. If they don't fall in line, if they maintain their own course and maintain that lower margin on these products, nothing potentially else could be a fantastic sector for brokers going forward within international accounts.
Yeah. I understand. Yeah, I agree with there. I think they need to, and I think they already started to do. I think they started to request data
Yes,
from like their global. I mean, where are they getting the clients from? They're asking the big brokers over there, where do you get your clients from?
correct.
Because I think they were, particularly maybe the IMF,
Yeah,
like the French regulator,
yeah,
but I guess ESMA in general, sort of trying to figure out where did these people go, because there
right.
are rumors, of course, that some of the Australian brokers are allowing people to open accounts with them, which I think technically and legally is fine. You're not just allowed to promote it, and I think that's what I mean. The regulator wants to make sure that. I mean, I think the legal view is that if you don't reach out to the people and they actually find you, then that's fine. I think that's quite sort of normal. But you're not, but I think the European regulator is trying to block that off as well.
Well, they can't do that. European regulators have no right, effectively.
Mm,
Australia is part of the world community. They're part of the global trading community.
mm,
They have trade agreements. So what they're doing is, if their companies have a product which you want, they are in their rights to advertise that product if they
yeah,
want. Okay, then there's no right, there's no political right for the Europe, for BaFin, the FCA, ESMA, SEC to come down hard on Australia. If they
yeah,
do, and then that's blackmail. That's political blackmail effect, and they can't do that.
yeah,
But Australia will have to, I think, really judge its position within the global banking world. There could be an issue. Say, for example, if Australia's told to regulate, well, actually, tell you what, if you're going to continue giving low margin these products, then we're going to stop your payments on SWIFT. I'll stop these payments. I'll stop your banking connections. That's actually a greater risk for Australia. So that actually, it is blackmail in a way.
yeah, yeah.
Yeah.
And I understand. Okay. All right. I think we got some very good input from you today, and I want to thank you so much for joining us, and
Thank,
hopefully we'll have you on soon again.
thank you very much. Look very carefully today. And look today, before I go, look today at the semiconductors. Because last night, Qualcomm reported falling sales again,
Hmm.
which qualifies that story about Apple and Samsung. So watch the semis today.
Awesome. Okay, guys, thanks so much for watching, and don't forget to subscribe to our channel. And Aman, you're on CNBC to see today, right?
It's 3:45, talking about the Federal Reserve. Funny
Okay.
enough.
Yeah, so on CNBC, but it's CNBC Arabia, right?
Yeah, Arabia, yes.
So you can check that out on their homepage. Thanks so much, Aman, and thanks so much everybody watching, and I'll hope to see you guys soon. Thank you. Bye
Thank
bye.
you.